أعوذ بالله الشيطان الرجيم بسم الله الرحمن الرحيم رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي. So in our lesson today we shall be talking about the financial statements. But just a recap of what we were doing yesterday. Yesterday we were talking about the double entry system, and we also talked about the accounting equation, and we also talked about the debiting and crediting transactions in the ledger book. So that is what we covered yesterday. So in our lesson today, we shall be talking in detail about the financial statement. Remember, yesterday we talked about this financial statement of the balance sheet, the cash flow, and the profit and loss statement, which sometimes is known as the income statement. So this is the lesson outline and objective. So number one, we shall be introducing the concept of financial accounting. Then number two, we shall discuss about the income statement. Then in our next lesson, next week, we shall be talking in detail about the balance sheet and the cash flow statement. So number one is financial statements. So what do we mean by financial statement? So financial statements, these are written records that convey the business activities and the financial performance of a company. So they are written, they are documented records that convey. Convey means they give us. So they give us information about what? The business activities, and most importantly, the financial performance of a company. That is the financial health of a company. How is the company doing financially? Is it doing well? Is it getting profit, or it's getting losses? So these are records that can really help us. It can give us a snapshot of what is happening in the company. So another definition in detail is what? That is, a financial statement is a formal record. So it is not something that is informal. It is something that is formal, that summarizes the financial activities and position of a business, organization, or individual. So when you are talking about financial statement, it is a formal document that summarizes the financial activities, all the financial activities. Financial activities means the transactions that normally happen on a daily basis. For example, buying, selling, taking a loan from a bank, buying goods from suppliers, taking a loan from a bank. All these are financial activities. And position. So they show us the position of a business. That is, are we getting profit? What is the position? Is the business profitable, or is the business struggling? So it can help us to know the position of a business or organization or individual, or even you as an individual, you need financial statement, you know. So for example, you can go to Dabshil Bank, and Dabshil can give you your financial statement, you know, what you've been, how money in, money out. So even you at a personal level, you are going to need the what? You are going to need the financial statement. So these statements provide an overview. An overview means a snapshot of the financial performance and financial condition. Condition is the same as position of an entity. Entity means business or organization of an entity over a specific period of time. For example, if you're preparing a balance sheet, then it has to be maybe of 2024, 2025 financial year. So these financial statements, they have a specific period. These financial statements, they are essential for stakeholders, such as number one, the management. The management, they have to make decisions on a daily basis. And they need this financial statement that can give them the information to make the decision. Investors, today, if I want to invest in your company, so before injecting my money, I'm going to ask you, I need to see your statements. Because I don't want to invest in a business that is dying. Then I come and complain later. No. Creditors, for example, the creditors are the banks. Before a bank gives you a loan, they are going to ask you for your financial statement. So they want to know if you can be able to pay their loan. And regulatory agencies, for example, regulatory agencies like the government needs your financial statement so that you can do what? You can pay the taxes. Okay. Now, what are the objectives of financial statement? Like, why do we normally have the balance sheet, the income statement, the cash flow statement? Why? Al-Ahdaf. Mahi al-Ahdaf. What are the objectives of this financial statement? Number one, financial information dissemination. When you are talking about dissemination, we are talking about distribution. When you are giving something, you are disseminating. So to provide, that is another meaning of dissemination, to provide relevant and what? Relevant and reliable financial information about the economic resources, obligation, and performance of an organization to its stakeholders. So number one is giving information. And this information, it needs to have two characteristics. Number one, it should be relevant. Relevant means it should be objective. It should be information that we need. And number two, it should be reliable. Reliable means it should be accurate. So it is basically giving us information about what? It is about the what? It's giving us information about the economic resources. Economic resources are the assets of an organization or business. What assets do we have? Number two, obligation, liabilities. What do we need to pay? And performance, the general performance of an organization to its stakeholders, the investors, creditors, management, regulators. Number two, assessment of financial performance to evaluate the profitability and operational efficiency of the business over a specific period. So when you're talking about profitability, we are basically talking about our revenues, our income being more than our expenses. But if our expenses are more than our revenues, then it means that we are not doing well. So it evaluates the profitability and operational efficiency. Operational efficiency means, can we be able as a business to meet our short-term obligations? So if we can be able to do that, then you are being efficient. So it is all about the liquidity of the what? It is all about the liquidity of a business being able to meet the short-term obligation. If you can be able to meet the short-term obligation, then you are being efficient. Number three, financial position evaluation. So to present a snapshot of the organization assets, liabilities, and equity as of a specific date, enabling stakeholders to assess its financial stability and solvency. So it gives us a summary of what assets do we have, what liabilities, and what capital or the equity we have at a specific date. And this will enable the stakeholders to assess the financial health or the financial stability and solvency. So when you are talking about solvency, it is the opposite of liquidity. Liquidity is, do we have enough money to meet the short-term obligation? On the contrary, solvency is, do we have enough money to pay our long-term obligation? Cash flow measures. So this financial statement, they provide insights into the organization cash flows and outflows, facilitating analysis of liquidity and cash management. So for example, the cash flow statement, it basically helps us to know cash inflow, the cash that is coming in, that is in terms of the revenues, and the cash outflows in terms of the expenses. So, and this will help us to analyze the liquidity. Liquidity means that do we have enough money? Because always as a business, you should be having some money in your pocket. You should be having some money in your account to pay your expenses, to pay the salaries, to pay your utilities. If you don't have enough cash, then it means there is a problem somewhere. Number 5, decision-making facilitation. So this financial statement, they support the management in doing what? In strategic planning and resource allocation decision by providing quantitative data on financial performance and position. So when you're talking about strategic planning, we are talking about long-term planning. So this financial statement will help us to plan for the future and also to do what? To allocate resources efficiently. Because as an organization, remember, Hunaka Nudra, we are working in an environment of scarcity. We don't have enough finance resources, human resource, the physical resources, they are not enough. So we need to allocate them efficiently. So this financial statement can actually guide us when you're making such decision. Compliance with legal requirement. So to meet statutory obligation and regulatory requirements, ensuring that the organization adheres to applicable law, e.g. tax reporting. It is a requirement in many countries that if you are an organization or you're doing business, you are required to submit, sometimes monthly. You are supposed to, for example, you are supposed to do what? You are supposed to pay the income tax. So if you have some people working in your organization, then the government will want you to pay the income tax. So this financial statement will really help the government when it comes to accountability when it comes to accountability purposes, because there are some businesses, they normally don't pay tax. Then investment and credit evaluation. So to furnish potential investors and lenders with necessary information to evaluate the risk of investing in or lending to the organization. So there are two things here. Number one is investment. So if I want to invest in your business, if I want to invest in your project, number one, I'll ask for your statements. I need to see your financial statement. Then credit evaluation normally happens with the banks. So you go to a bank, you need a loan of, for example, $1 million. So before the bank gives you the money, they'll ask you for your statement to see if you'll be in a position to do what? If you'll be in a position to repay back their loan. Performance comparison to enable stakeholders to compare the organization's financial performance and position against prior periods, industry standard, or competitors. So this financial statement can help us to, number one, compare our performance with prior periods. For example, we are in 2025. So in 2024, our organization had what? The financial statements. So we can easily compare what happened last year versus what is happening today. So it can easily, and you can even compare what has been happening for the past 5 years, 6 years, compared to what is happening now. And it can help us to make decisions that are progressive. Then it can also help us to compare with industry standards. So for example, in each and every industry, we have the education industry, We have the telecommunication industry. If you're working it, we can easily compare. Then also we can compare ourselves with our competitors, right? We can easily compare. So for example, if you're having the Dahabshil, Premier Bank, and maybe Amal Bank. So all of them are in the same, they're competitors. So they can easily compare themselves. Okay, how are we doing as compared to our competitors? And it can help us to know the areas that we can maybe improve on to be better than our competitors. Now, what are the importance of this financial statement? Number one, informed decision making. Remember, before making any decision, you need what? You need information. So where are you going to get this information? The financial statements are going to give you this information. So the information you get from the financial statement will help you to make an objective decision. Number two, financial performance assessment. So this financial statement, they serve as a basis for evaluating an organization's overall performance and profitability, enabling stakeholders to identify trends and make performance comparison. This is what we were just saying before. So it helps us to do what? To assess our performance. Are we doing okay? Are we getting profit? Yes, we might be getting profit, but the profit margin is not, the profit margin is decreasing. Yes, we are getting profit, but the profit maybe margin is declining, or maybe it is also increasing. Resource allocation, we've already talked about this financial statement. They help us to allocate resources efficiently, putting the right resources in the right place. That is what is known as efficiency. Then transparency and accountability. Transparency is all about shafafia. So financial statement promote transparency in financial reporting because we give all the stakeholders our financial statement so they know how we are doing. And this will foster, if we are open, then people are going to trust us. And the opposite is also true. If we are not open, who is going to trust you if you're not open? Nobody. Legal and regulatory compliance, we've talked about this. So it's all about they fulfill legal and regulatory requirements, ensuring organizations provide accurate financial information to regulators and comply with financial reporting standards. Creditworthiness assessment. Creditors rely on financial statement to assess the organization creditworthy. This is what I was just saying. Creditworthiness assessment means this normally happens with the bank when you go to ask for a loan. So they will have to assess if you are in a position to pay their loan because they don't want to take risk. Like they give you millions, thousands of dollars and you don't pay. No. Valuation of the organization. So investors and analysts use financial statement to assess the intrinsic value of a company, aiding in the determination of whether it is undervalued or overvalued in the market. So investors and analysts, they use the financial statement to assess the value of a company, because sometimes there are some companies, they might be playing around. They might not be giving the full information. They might be portraying themselves as if they are doing well. But in real sense, they aren't. So the financial statement can help us to actually know the intrinsic value. When you are talking about the intrinsic value, it's in terms of the monetary. So the intrinsic value, for example, now we have the Google company or the Apple company. So they normally tell you like the Google company, it's worth maybe $4.3 trillion. The Tesla, if you go to the world, if you go to the stock market, so then number 7 is the trend analysis. So financial statement provide the data necessary for trend analysis. And what is trend analysis? When you're talking about trend analysis, is the assessment of the company's historical performance and prediction of future performance. So in an exam, sometimes you can be asked what is trend analysis. So trend analysis basically means we are assessing our company like what happened yesterday. How was the performance of our company yesterday? And based on the data information we get, we predict what will happen fil mustaqbal in the future. So it is all about al-madhi, madha hadatha, and we use this information of what happened to try and plan at-tanabbu fima sayahduth fil madha fil mustaqbal. So that is what is meant by trend analysis. Then also it facilitates planning and budgeting. So financial statement guides strategic planning and budgeting by providing historical financial data that help focus future revenues and expenses. So this even normally happens at a country level. The government, they normally budget. How do they budget? So they normally budget by doing what? Reviewing their financial statement in the previous year. Based on that information, they predict, they forecast what is going to happen in the coming years. Facilitating mergers and acquisition. So when we were talking about strategic management, remember when we talked about mergers and acquisition, what is the difference? You can be asked in an exam. What is the difference between mergers and acquisition? So when you're talking of mergers, it is like Telesom and Somtel. They merge together. So merging, they basically means they are going to cooperate, they are going to work together in some areas. But still Somtel is going to be independent, Telesom is going to be independent. So they're just working on a certain area, maybe research, or they're working on innovation, ila ghairi dhalik. But when you're talking of acquisition, it is Telesom, they are acquiring. Acquiring means what? They are buying Somtel. So Somtel, everything in Somtel is now going to be under Telesom. So there is no, you will not be having any organization or company called Somtel. So Telesom is going to buy it and it's going to change the branding. Everything is going to be under them. They are acquiring. So they are buying the assets, and sometimes they can even decide to employ those people who are working in Somtel. They can decide to employ, or sometimes when they acquire, they can just tell, like, there's people who are working in Somtel, we don't need your services. So the financial statement can help us. For example, if you want to buy a company, so now, before buying the company, you need to know their financial statement. Are they doing okay? Because you don't want to buy a company that is not doing okay. So that is all about the importance of this financial statement. Okay, now number 1. So we've said we are going to look into 3 major financial statements. So number 1, we have the income statement. There are 3 statements. Remember, there are 3 statements. We have the income statement, we have the balance sheet, and you have the cash flow statement. These are the 3 main important financial statements in any business or organization. So let us start with the income statement. So one of the three important financial statements used for reporting a company's financial performance over a specific accounting period, with the other two key statements being the balance sheet and the statement of cash flow. So it is one of the three, the income statement. Now, what is the income statement? When we're talking about the income statement, it is also known as the profit and loss statement. So sometimes in some books, you will see the P&L statement. So it basically means the income statement. It has many names. So in some books, they'll use the word, the income statement. Some books, they'll use the profit and loss statement. In some books, they'll use statement of earning. In some books, they'll use statement of operations, but it still means the same thing. So what is this statement? So it is a financial document that summarizes a company's, number one, revenue, costs, and expenses over a specific period, typically a physical quarter or year. So sometimes it can be quarterly after 4 months, or sometimes it can be prepared it can be prepared annually. So this is a statement that gives us information about three things. Al-iradat, what are our revenues? Number two, at-takalif, what are our costs? Then lastly, al-masarif, what are our expenses? So it summarizes, it gives us a snapshot of these three things. So the primary purpose of the income statement is to provide an overview of a financial performance, of a company's financial performance, showing how much profit or loss it has generated during the reporting period. So this statement will always help us to know the al-arbah, the profit that we've got, or al-khasair, or al-khasara, over a specific period of time. So the key components of an income statement are, number one, you'll always be having revenues, al-mabi'at, sales, the things we are selling, the cost of goods sold. When we are selling goods, we normally incur some cost of goods sold, the gross profit. Then lastly, we have the what? No, we have the operating expenses, the salaries, the rent, utilities, then operating income, then lastly, the net income. The net income is after taxes and interest. So in brief, this is the what? This is the income statement. Now, for example, we only look at one example. Now, always you'll have the revenues. So in our case, for example, so when you're preparing an income statement, you normally have the name of the business. For example, company name, the ABC Consulting Services. Then the period needs to be there. The income statement for the year ended, it has to be there. Now you have the items in one column and the amount. So for example, so this is a company, this is a business that is giving service. So we have two types of businesses. Some businesses, they do what? Some businesses, they give services. Some businesses, they do what? Some businesses, they deal with products. So it is slightly different when you are dealing with services and when you are dealing with products. So in this case, we have what? We have the revenue. So this consulting company, Al-Iradat, they got revenues of $150,000. Let us assume that was for the period that ended 2023. But for that period, they had some expenses, salary, rent, utilities, and marketing. Okay? Now, So their total expenses was what? $8,600. Now, what is their net income? Very easy. So it's just the difference between the revenues, 150, minus the 8,600. So at the end of the year, so this company, it did well because their net income was a positive number. So sometimes you can be given some data to analyze, and they want you to explain, give an explanation. So in this case, this company it's doing well because the number is positive. But sometimes if you get the number as a negative number, then it means the business is making loss. So this is for a service. So this is just the explanation. Revenues, the total income generated from providing consulting service. Expenses, the cost incurred to operate the consulting business. Because when you're operating the business, hunaka takalif wal masarif. Then the net income, the profit calculated by subtracting total expense from total revenues. As easy as that. Now, number two here, now this is a company that is dealing with product. The first one was service. Now this one is dealing with what? This one is dealing with what? This one is dealing with, it's dealing with products. So there is a slight difference. So number one, we have the revenues. So the sales revenue from selling the clothes. Remember, the title has to be up there, the company name and the income statement for the period you're talking about. Now, the sale revenue is $300,000. Now, this thing, the cost of goods sold, it was not here when we were talking about the services. The services, there is no cost of good. So that is the difference between the income statement in what? In businesses that deal with service versus the difference, the business that deals with what? Product. So the cost of goods sold. So opening inventory, that is the opening inventory. It means that when these goods, when you were at the beginning of the year, this is what we were having in our store. So you are having in our store opening inventory, we are having some clothes worth $50,000. Then the purchases and the things that we sold, al-mushtarayat was $150,000. Then the closing inventory. Now, when at the end of the year, what did we close with? It is 30,000, but this means it's negative. So the closing is negative. So the total cost of goods sold will be what? Will be 200. That is 50 plus 150. You minus the closing inventory, which is 170. Okay. Now, our gross profit will be 300 minus 170, the red ones. Okay. Which will give us 130. Now, the operating expenses, we have salaries, we have rent, we have advertising. The total operating expenses is 80,000. So the net income, you will take the 130,000, that is the gross profit, you minus the total operating expenses. Now our net income will be 50,000 USD dollars. So that is how you go about it. And this is now the explanation. Now, this is the explanation of what? This is the explanation of everything that has been happening around. The sales revenue is the income generated. Cost of goods sold, the total cost of inventory sold during the year. It is calculated as opening inventory plus purchases minus closing inventory. Gross profit, the profit from sales after subtracting the cost of goods sold from total revenues. The operating expenses related to running the business, such as employee salary, rent, and advertising. Then lastly, the net income, the final profit after all operating expenses are deducted. So we have another example here, and these are now the importance of the what? The importance of the income statement. So that's the end of our lesson for today. So you'll just read about the importance of the income statement. Why is it important? So in our next lesson, we should be starting in the balance sheets. So in our next lesson, next week, inshallah, we shall start talking about the balance sheet plus the what? Plus the cash what? The cash flow statement. So that we will cover those two statements in our next lesson next week. So, and next week, inshallah, we shall also be having a quiz. The quiz will be out of what? The quiz will be out of 20. Because your attendance is 20 marks, the quiz will be 20 marks. Then your final exam will be 60%. So the 60 plus 20 plus 20, that is 100. So by next week, I will be giving you information about the quiz. Okay? So you'll get more information about the quiz in your next lesson. So is there any question? We have only 1 minute remaining. Is there any question? If you have any question, you can ask, please. If you have any questions, so I'll be sending the link for the attendance. The attendance is very important. If you miss taking the attendance, it means you miss 5 marks. Any attendance you miss, it basically means you miss 5 marks. So you have to be very careful with the attendance. And I will share the attendance marks at the end of the course so that you know what you have scored in the attendance. So I think that's the end of our lesson. We'll meet next week, inshallah, if there is no question.